Hello and welcome to McDermott Will and Emery's weekly webinar on issues impacting the energy industry during the COVID-19 crisis. I am Ed Zelke. I am the global head of McDermott's Energy Project Finance practice, and it's good to be with you again this week for our 14th consecutive half-hour Thursday seminar webinar on energy issues. Today's topic is what's new in private equity, trends and developments in a shifting investment landscape. Joining me today is my partner, Chris Gladbach from our Washington, D.C. office, and our special guests, Jeff Hunter, a senior advisor for power and infrastructure and renewable energy at Apollo Global Management, and Andrew Ellenbogen, managing director of the investment team for power and renewables for EIG Global Energy Partners. I want to remind the audience that we do have a question and answer button at the bottom of your screen. So if you have questions during the webinar, please feel free to push the button and type in your question, and we will see if we can get them answered in live time. If not, we'll see if we can reach out to you after the webinar to give you the answer that you're asking for. And before we begin, as we often do, we'd like to start with a couple audience participation questions, and we'll put those up. The first is ties to today's topic. According to Infrastructure Investor, how much money did the top 50 funds raise last year worldwide for infrastructure investing? Let's see how much dry powder is out there. 296 billion, 496 billion, 696 billion, or 896 billion. Why don't you type in your best guess, and let's see what the audience thinks, and then we'll compare it to actual and factual. And the answer is, best guess is 696 billion. You're a little high. The correct answer is 496 billion. Still a lot of money, but maybe given the stimulus packages, 500 billion, it doesn't seem like as much as it used to be, but still quite a bit with the top 50 funds last year. Let's go to our second question. This is more focused on kind of how you're feeling about the being sequestered at home during all of this. With the resurgence of COVID-19 in some states and the election 4 months away, not to mention, I guess, unrest in the streets, which Harrison Ford movie best describes the mood of the country between now and Election Day? And I picked Harrison Ford. You know, if I was going to pick an actor that seemed like he'd be an infrastructure investor, he seemed kind of like he'd fit the bill. So the movies are, of course, Apocalypse Now. How could we not put that one in here? Cowboys and Aliens, a movie that probably most people haven't seen, but it's your classic, you know, good versus evil, depending on whether you think cowboys are good or aliens are good. Blade Runner, the 80s classic, or the ultimate social distancing movie, The Call of the Wild. So why don't you vote, and we'll see what the audience thinks. So 39% is going for Apocalypse Now. Not a good sign. I was hoping for a little more positive outlook by the audience between now and Election Day, but with 40% thinking that we're going to see Apocalypse Now with the research and COVID and everything else going on, well, we'll continue doing webinars and see if we can work our way out of it. All right, so let's move on now to the program. Again, Chris Gladbach is joining me today from our Washington D.C. office. He's a partner in our energy project finance practice. Our special guest, as I mentioned, Jeff Hunter, Senior Advisor for Power and Infrastructure and Renewable Energy for Apollo Global Management. Jeff is a seasoned energy executive with 25 years of experience in the global energy sector across a broad spectrum of finance, acquisitions, investments, operations, and advisory services, energy trading, corporate development, mostly in the U.S. electricity and natural gas markets. Also joining us is Andrew Ellenbogen, Managing Director for Investments, Power and Renewables for EIG Global Energy Partners. Andrew is a member of EIG's Investment Executive Committee with a primary focus on energy and power generation assets, Prior to joining EIG in 2011, Andrew was vice president in Morgan Stanley's Power and Utilities Investment Group. Welcome, Jeff and Andrew. Thank you for joining us today. Let's start with just a couple softball questions. First, I guess let's start with you, Andrew. Maybe you can just give us, the audience, just a quick glimpse of who EIG is and why are you in the U.S. investing in energy and infrastructure.
Sure. So thanks very much, first and foremost, for having me and us and putting this together. This is great. So EIG is an energy-focused investor. We've been around for about 35 years and have continued a singular focus in energy throughout that time. Within energy, we break the world down into primarily three verticals: upstream, midstream, and power. And I focus on power and sort of other fixed assets that would fall into that general camp. We manage just over 20 billion of capital, and that capital we tend to deploy into capital solutions for our partners that are helpful for whatever stage of development and evolution of the business that may be most useful. So typically that on the low end might look like sort of a credit kind of solution. So some kind of a loan type structure, if that's what's optimal for a partner's capital stack, all the way up through structured debt. So that same piece of credit with some kind of an equity participation or a kicker. So debt with warrants is a common example, through preferred equity, and then non-control or shared control common. We're not typically a control common investor. And so what we're looking to do ideally is to work with teams and companies that have some kind of a great ambition, a new project, a restructuring, a refinancing, an acquisition, a growth plan. And so there's that ambition, but there's a need for the capital to facilitate that. And so we're looking to be a helpful capital partner, but not to get in the way of our partners and to take over the company or the management. And so usually it's something that runs the realm of that sort of credit solution through sort of structured equity. And we find that it's been a pretty useful and helpful product, in particular in our world these days in power and in renewables. Folks that have new projects to develop, folks that have platforms to evolve, et cetera. So it's a very exciting time. I think we're undergoing a historic shift in the overall energy system globally, the power system in particular. So it's a great time and a lot of exciting things going on.
Thank you, Andrew. Jeff, I know you wear several hats, including as a senior advisor to Apollo's infrastructure fund. Give us a little bit of your background and what it is you're doing these days.
Yeah, I'm a bit new to Apollo, so I can't really speak on their behalf. I can really just kind of spend a moment telling you about where I've spent my time in the recent past and kind of where I see the investment landscape going. I started off in thermal with U.S. Power Generating, backed by Madison Dearborn Partners out of Chicago. In 2005, we acquired several thousand megawatts in New York and New England, sold that company off in pieces, and then more recently, I was with Quinnbrook Infrastructure Partners, where we invested pretty heavily in renewables, wind, solar, solar plus batteries, and then battery storage, mostly sort of backing management teams and ramping that up. I think Apollo is a bit more of a control investor, so we're looking for opportunities in this energy and transition space at the time. And it looks like, there's a lot of capital chasing the space at the moment. It seems as though thermal is a bit of the neglected child at the moment. So it looks like, we're gonna have to spend our time being creative about where to earn returns in this space, given all the competition with cheap capital.
So Jeff, you mentioned creativity, and I think that goes to the next question, which is what are your respective firms looking for in the current market, and has the investment criteria changed from say 5 years ago? Obviously, we're in the middle of COVID-19 But beyond that, how has your thinking developed around what you're looking for in investments? I'll start with you, Andrew.
Sure. So I would say that we have tried to be really consistent about the criteria that make sense for us and for our investors over the course of time. So we've tried to keep those criteria quite stable. I think what has moved and changed has been sort of what are the kind of leading and base case assumptions that you're baking into the underwriting that you're undertaking. And so maybe not 5 years ago, but call it 10 years ago, it would have been tougher to imagine the sea of natural gas that we'd be swimming in. And so kind of a natural gas environment that's going to be in the $2 to $3 area for a long, long time. And that informs the economics for power investments up and down the spectrum, be they renewable or thermal. The things like the decline in the cost of the capital costs associated with renewable projects, the increase in capacity factors and efficiencies in renewable assets and technologies has been pretty, I would say, surprising. I think we expected it, but not quite as extensive as it was. When I started looking at solar, 13, 14 years ago, we were talking $6,000, $7,000 a kW, and now, under 1,000 for utility scale. So it's those sorts of inputs that have changed and have impacted where we're looking. We still look across the spectrum in terms of thermal and renewables. I would say, our general point of view is that most markets in the U.S., perhaps with the exception of Texas, don't seem to need a ton of new generation, particularly new baseload thermal generation. Maybe there's peaking that could be necessary, and then renewables are coming in as a function of preferences, corporate PPAs, and subsidy and tax regimes. So all of that kind of informs how we're looking at the world.
Jeff, any reactions to that? And I know you're new at Apollo, but thoughts about what you're looking for in the current investment, Craig?
Yeah, no, I think the renewable space, as I said earlier, is quite crowded with all sorts of different sources of capital. I think also, Andrew kind of hit on kind of one of the more important points at the moment, which is, what are your underwriting criteria as you go into this? Certainly the price of natural gas and the virtual flood of natural gas has been a big component of that. What do you believe about the forward curve and the useful life and the capacity factors of the various different technologies? And then what do you believe about the technology cost curve and how will the respective markets evolve from, PJM to ERCOT to California? And how do you obtain those sort of outsized returns relative to the core infrastructure type returns that you would get in a fully de-risked asset or investment? So I think people have to be prepared to take risk. It's a matter of what risk are you taking, whether it's development or whether it's merchant or some component of the two. And then what's financeable in today's market? It doesn't seem like the market is getting any less frothy with respect to equity. Maybe tax equity could be an issue, but I think we're all still waiting to see what the tax bill holds.
And do you think COVID's changing the calculus, or do you think it's still a seller's market?
I think where COVID has come to bear is that we've seen significant demand destruction, across the U.S., varying from market to market between 3% and 15%. And it's a question of how quickly will that come back, and then what's the impact on that demand destruction, both in oil and natural gas, which is sort of typically the price-setting fuel in most of these markets.
Andrew, do you see a lot of competition for sort of well-structured projects? Do you see the wall of capital as high as it used to be?
Yeah, well, the answer at the front of the session said a lot in terms of the amount of capital, right? 500 billion is a lot of dry powder to be on the sidelines. I figured that was the right answer, but feared to check that box. Um, uh, I think what's interesting is there's a ton of capital in certain segments of the market. So really well-structured projects have a ton of capital chasing them. There's, I think, more opportunity probably in projects that are a little bit less buttoned up, or in working with platforms and having a view towards the prospects of that platform in their evolution, their ability to develop new projects and bring new projects to NTP and or COD. So there are opportunities there. I mean, if you step back and you look at the capex spend that will be needed globally in the power space over the next 30 years, that number is something like 10 to 15 trillion dollars. You sort of say, okay, well, a bunch of that is going to be debt. It's still a multi-trillion-dollar number. A bunch of that are going to be projects that are probably lower return than a lot of sort of infra or private equity style investors can pursue. Okay, fine. Even so, the opportunity set's enormous, and the as I said, the radical, dramatic change that we are undertaking to the system is huge. And so, it's crowded, but that's exactly. It's crowded, but there's enough opportunity out there that we're pretty optimistic that there's going to be, lots of interesting stuff to find. And I think Jeff would agree that you want to have history in these markets, and you want to understand sort of the dynamics and experience through cycles, and be able to identify from within that very broad funnel at the top, the stuff that should make it down to the bottom of the funnel. But it's enormous, and so very crowded, but a ton of opportunity as well. So we continue to be, pretty excited, and it's just a fun area to be working in.
Certainly agree with that. Ed, did you want to ask the clean energy question? We may have lost Ed. Are you there?
He's on mute.
I apologize. I had muted myself too. I stopped a barking dog in the background. I should be back now. So I was going to follow up with Andrew. You mentioned some interesting stuff. Does that mean clean energy, or is clean energy kind of run a lot of its course, and we're now looking at more interesting stuff for the next 5-10 year horizon?
What do you mean by that, Ed?
I mean, we've been so much investment in solar and wind and battery. Is that still where the action is, or is today's investor now looking for something different? Is it now climate investing, or is it other technologies? What are you guys taking a hard look at?
Yeah, no, the answer, I see a lot of both, I would say. 10 years ago, clean tech was the thing. And I think nowadays you're starting to hear the term climate tech get thrown around, maybe because clean tech is sort of verboten. But you've got a number of investment groups now chasing more like the enabling technologies that will facilitate the transition. So we're seeing a lot more of that. The weight of gravity that's moving to places like Silicon Valley and the Bay Area in power and renewables is growing. So we're seeing a lot of that. We're seeing a lot of firms that are spending time on adjacent spaces like services. And so they're sort of saying, I can't see the returns that I need to deliver in single assets. And so let me apply the knowledge that I have of this space to something like O&M providers, EPC providers, construction companies, et cetera. So there is a move, I think, to extend the skill sets and the training and the knowledge base to adjacent areas. And then within kind of traditional assets, so solar, wind, the sort of twists that are driving attention and return tend to be, well, what happens when you take the solar and you combine it with now storage? So that's clearly a trend that's coming in a big way. offshore wind. The U.S. has very little experience in that, and so there's a lot of construction risk. There's not really a constellation of service providers to do it, so there's risk to be had there. Query whether that risk is priced in the PPAs, but TBD. And then a lot of folks naturally are taking a hard look at how much additional development risk they may be willing to take and how much additional merchant risk they may be willing to take. And that is certainly a trend as well.
Jeff, on the same topic, you've spent a fair amount of time in thermal. Is thermal going to make a comeback here in terms of investing for private equity investors, or are the ESG requirements going to continue to kind of push the cleaner technologies?
Well, I think the biggest problem with thermal historically has been the new thermal that we would need is still pretty expensive, and nobody's ever actually really gotten their money back by building new combined cycle or combustion turbine plants in the U.S. in any market that I'm aware of over the last 20 years. So I think people will still be a little bit loath to sort of invest in new thermal build out. I think you'll still see and continue to see assets turn over in the marketplace through troubled credits and over leveraged, like we've always seen through all the different cycles. This is just one more version of the same cycle. So I think thermal's going to take a back seat to renewables and sort of clean tech, as Andrew stipulated. And I do believe that he's right. People are looking at how to earn their returns outside of just buying fully de-risked assets, whether it's taking that development risk or investing in the technology or a third-party service provider such as an O&M provider. How do you get more exposure to the space, but have the ability to earn an outsized return relative to a core investment? And I do think that we're seeing more and more of that as the technology shifts and the cost curves shift. It's going to create more and more opportunity up and down the value chain as we go through this energy and transition phase. And probably the best opportunities in thermal are really what do you do with all these old thermal plants that are laying around that are no longer really economic?
Is there anything you want to avoid these days? I mean, if combined cycle plants aren't maybe the strongest item that's attracting you, and you're looking kind of in these we'll call them midstream, if you would, related to wind and solar certain servicing companies. Are there technologies that you see large investors just staying away from, whether it is offshore wind, as Andrew mentioned, or biofuels, or other things that folks you see staying away from? This is for Jeff.
Yeah, I think people are staying away from the things that are just not cost competitive. If they're not facilitated by a mandate, whether it's an RPS standard or a mandated IRP, which requires the purchase of offshore wind, regardless of price, then I do believe that people are staying away from the higher cost things, whether it's biomass that has been plagued for a long time, or any kind of new construction on the gas side. So I think that obviously everybody's steering away from coal. I don't know that you can acquire it or finance it at this moment in time, but something's got to take its place. So obviously coal's sort of the third rail, and then there are certain technologies that are evolving, and nobody knows exactly what the winner is. Today, it obviously looks like some form of lithium on the battery storage side, but there are also battery technologies that people are investing in that they're either going to come and go really quickly, or they may have a sustainable competitive advantage. But I mean, I think at this point, really, it revolves around the Chinese supply chain for battery storage.
Interesting. Chris, before I hand it back to you, I did have an audience question I wanted to run by Andrew, and that is, what is the typical investment check or dollar amount for projects that EIG pursues?
Sure. Short answer is something like 50 million to 200, 300, 400 million. Can sometimes be a little bit smaller if necessary, and in particular if there's a path towards further deployments or an extended relationship in which we might get back up to something in that range. But that would be the short range.
Thank you.
So, are there any regions in the United States that are particularly attractive right now for investing in power assets, uh, or the opposite, that regions that you would tend to avoid in the current environment?
Is that for me or Andrew?
Jeff, please.
Okay. Look, I mean, I think with the increase in the RA payments out in California, California starts to look interesting again, but the cost and the time to develop in California is very high and very long and very complicated. And you do run into a lot of sort of local issues. ERCOT, as Andrew stated earlier, probably the one market that's, got growing demand. It's got a relatively low reserve margin. It's got a high penetration of intermittent resources. So I think we'll see more of a build out of solar and battery storage in ERCOT. But none of the markets have really come up with a market-based sort of compensation mechanism for BESS outside of stipulated contracts such as the RA contracts in California. In PJM, you're chasing a reg D signal. In ERCOT, you're chasing the sort of the 5-minute interval pricing and reg up, reg down. So there's just not really a great sort of visibility or view as to what the value of ancillary services are going to be over time and how that's going to evolve with a higher penetration of storage, whether it be batteries or other forms of storage, whether it's, pump storage or something else.
Andrew, any reactions to Jeff's regional analysis?
Yeah. I guess my overlay on it would be I look at most of the markets in the U.S. and I don't assess that most of them are in great need of new base load. If I start there, I would say that some of the markets, in particular the ones that are getting more penetrated by renewables, would benefit from more reactive, quickly dispatchable thermal power, so peakers. California probably stands out as the most attractive in that regard, but you can't build and you can't build anything new thermal there. So, we have actually recently made investments in existing thermal peakers in California that were predicated on this very topic. One, barriers to entry. Two, the need for responsive power, and the market has shown up with improved RA prices that have sort of validated it. I think Texas likewise probably needs that peaking capacity, but unfortunately Texas doesn't have great barriers to entry in new build, and you've got a bunch of sort of peakers that are waiting to go. So the minute there's a signal, a few of them can show up and the signal gets diminished. So it's a harder market for us to get our arms around just because it's easier to build thermal there. Those are the primary ones I would focus on. I don't look at PJM and say, it needs much of new build of anything, given the wave that's come on, and New York and New England are quite small relative to those that I mentioned. Then in renewables, it really sort of comes to subsidies and the regimes that are in place there and the RPS standards. Going back to one of the earlier questions, I will say that, in terms of things to avoid or at least be careful about, we have been very tentative about things like basis risk that has been present in a lot of projects as we've moved from utility PPAs to hedges. We don't underestimate. We've lived basis risk in thermal assets, and we get it, and you got to get it and not underestimate it. So we've been very careful about exposures to that sort of risk, and as well as back end prices. So you got to step back and say to yourself, what do I need to believe in? Call it ERCOT in 2035 is the price, and if that number is makes sense relative to where we are today, relative to $2-3 gas and an ever increasing number of zero heat rate generation items at the front of the stack, does, pick your number, 60, 75, 80, $90 a megawatt hour in 2035, 2040 makes sense. Leave it to folks to decide, but we have been pretty tentative on making those sorts of assessments.
Yeah, I would tend to concur with Andrew that one of the biggest mistakes I see some of the buyers making is either underestimating basis risk or covariance risk, and then accepting consultancy curves in the back of the post hedge expiration or PPA expiration period to do their valuations. And, the idea that, we're going to see $70, $80 prices when we're going to get a higher penetration of renewables, and gas is still going to be probably the marginal cost generation.
Right.
And there's no real view that gas is going to be $6 or $7. So how you get to 80, 90 is really tough to get there.
Gentlemen, as you can tell, a half an hour goes very fast. We've still got a whole page of questions to ask you, but we are nearly out of time. In fact, we kind of are out of time. But I did want to ask you one audience question real quick. The question is, there has been some tightening in the tax equity markets because of COVID-19. How has that impacted your speed at which you're trying to deploy capital, especially in the clean energy space? Would you say it has had no impact? It's caused you to hit the pause button a little, hit the pause button a lot, or pull yourself on the sidelines and wait to see what happens? Start with you, Andrew. What's the impact of the tightening of these markets been on you?
It's both risk and opportunity. So we've had projects that we've been looking at that the sponsor comes to find, was not going to manage to get tax equity this year. And so you wind up into next year and you wind up hitting the stair step on, let's say, an ITC, and you've got to recut the economics and then figure out whether those economics work. In some cases, those economics have not worked, and that's sort of where it's the risk. In other cases, it's where the opportunity is. So there's a piece of the capital stack that is not there, and so folks like us who are providing capital solutions can help by stepping into the breach, and that has been an active discussion as well. It leads though to pretty challenging circumstances when you have a project that may or may not be able to achieve something like 20 to 30% of its capital cost in the form of that credit. So it's hard to recover when the tax equity piece is diminished. And what we've seen in terms of this year and the beginning of next is that it's the strongest sponsors that seem to be lining up the tax equity capacity. And, if you're a younger company or less well established, it's more of a challenge, and the relationships are all critical.
That's right.
I'm sorry, Ed, I couldn't hear you.
I said, any final thoughts?
No, I completely agree with Andrew that if you're not in the queue for tax equity now, you're not probably likely to be in the queue. And it is going to go to the strongest sponsors and the serial issuers. And it is problematic to be competitive with a project as you look, and let's, the fact is people are just moving it out a year. But then, as Andrew said, they're going to be stepping down their ITC, level of participation. So it's going to challenge the economics, especially if somebody's looking for a PPA in the current market. Those who have tax equity and qualified sites and qualified components are in a much better place than those who are actually trying to get a project off in 2021 that don't have committed tax equity today.
Agreed. Chris Gladbach, thank you for joining me as host today. Jeff Hunter, a senior advisor for Apollo Global Management, Inc., and Andrew Ellenbogen from EIG Global Energy Partners. Thank you both for joining us today. This has been a great conversation. And we will try to get to a number of these questions after the webinar is over. We do have a long list of folks that have written in during the presentation. But again, thanks for joining us today.
Yeah, thanks so much. It's been
Thanks,
great.
Lou.